Every trader is looking at this market right now and thinking the same thing. Why isn't it crashing? And why does it still feel risky? Because this is not a fear-driven market. It's a positioning market. And if you don't understand that difference, you're going to trade this week completely wrong. This is your weekly market recap for the week ending April 10th. In this video, I'm going to break down what actually moved the market this week, why stocks are starting to move faster, why options are quietly getting more dangerous, and the exact watch list you should be focused on going into next week. Let's get into it. 1. Market behavior. This week, the market didn't break down. It didn't panic. It didn't even trend strongly. Instead, it paused. We saw sideways movement in the S&P 500, strength in the Nasdaq, and elevated volatility, but no spike. That combination tells you something very important. This is not a market driven by fear. This is a market driven by positioning. Institutions are not exiting. They are adjusting. They are preparing. 2. Macro layer. Now let's talk about the macro backdrop. The Iran situation continues to create uncertainty. But here's the key insight most traders miss. Markets don't crash because of bad news. They crash because of uncertainty about that news. Right now, the market is not panicking. It's watching. And that's why you're seeing hesitation instead of collapse. 3. Earnings shift. But the real shift this week wasn't macro. It was earnings positioning. We are entering the pre-earnings window. And this is where the market starts to behave differently. You begin to see stocks drifting higher, breakouts happening faster, and fewer pullbacks. If you felt like moves were happening too fast this week, you're not wrong. That's institutional positioning ahead of earnings. 4. The options trap. Now here's where it gets dangerous. As stocks move higher into earnings, options get more expensive. Implied volatility starts rising. Premiums expand. And this creates a trap. Because it feels like you should be buying calls, but in reality, you're paying more for less edge. This is how traders lose money quietly. Not from being wrong on direction, but from overpaying for volatility. 5. Why this is not a leaps environment. This is very important. Right now is not an A+ environment for leaps entries. Leaps work best when price is near support, volatility is low, and uncertainty is stabilizing. Right now we have rising volatility, extended charts, and pre-event positioning. That's not where you want to deploy long-term capital. 6. What you should be doing. So, what's the right approach? You adjust. This becomes a tactical market, not a conviction market. Right now, the focus should be short-term swings into earnings, selling into strength, and waiting for post-earnings pullbacks, because that's where the real opportunities will show up. 7. Watch list for next week. Here's the watch list you should be focused on. No overcomplication, just leadership. AI and infrastructure, NVDA, Microsoft, Broadcom, Meta, Oracle Momentum and Growth, Palantir, CoreWeave, Semiconductors, AMD, MU, ARM, and for overall direction, QQQ, SPY. You're not trying to trade everything. You're watching where money is flowing. 8. What to watch next week. Going into next week, your job is simple. Watch for 3 things. Are stocks continuing to drift higher into earnings? Do we get pullbacks to support? And does volatility continue rising or start to peak? You are not predicting. You are reacting. As you can see, most traders will struggle in this type of market. Not because there are no opportunities, but because they feel the need to always be in a trade. But the real edge right now is discipline, waiting, and acting only when the setup is clear. Because in markets like this, the biggest gains don't come from more trades. They come from better timing. If this breakdown helped you see the market more clearly, make sure to subscribe. Every week, I break down the market through the lens of leaps and smart positioning, so you can trade with clarity, not emotion. Thank you for watching, and see you in the next video.